Hello, welcome back to my channel. This is Chrissy Wang. I'm a CPA and product manager. As you can see, this is a very unusual way for me to open the video. That's because I'm wearing my signature Oakley sports sunglasses, and I figure I need to do something sporty with my intro this time. By popular request, I'm wearing this pair of sunglasses because this is my personal brand in the office. I wear my professional clothes with this pair of sunglasses. I go to concert in these. I basically do any outfit, do any activities with this pair of sunglasses. I love it so much to the point that people recognize me outside the office because of my sunglasses. All right, without further ado, I hope you're excited for recent round of financing approach. As I was preparing for the video, I thought I could go straight into discussing what recent round of financing approach is. Then, as I was putting together the material, I realized, whoa, there are actually so many things to unpack first before we get to talk about the recent round of financing approach. The first concept I want us to understand is the difference between shareholders and creditors. Let me zoom in on this little cute Shiba that's thinking about how do I invest in a private company. There are two ways to invest in a private company. Option number one, you can buy the company's shares, or what we call stocks, or you often hear people say equity. The second way to invest in a private company is to give the company loans. And depending on which approach you take, you become either a shareholder or a creditor to this company. When you buy shares, when you buy stock, when you buy equity, shares, stock, equity, they're the same thing. You become investor in private equity of this company. Investors who own equity in a company are called shareholders. And when you give the company loans, you're investing in private credit, and investors who lend money to a company, private company, they're called creditors. Investors who lend money, You know what? I'm gonna start over again. First, I want us to understand the difference between shareholders and creditors. Sorry. To start, I want us to understand the difference between shareholders and creditors. So on my screen, I have this cute little Shiba that's thinking about how do I invest in a private company. Great question. There are two ways for you to invest in a private company. The first approach is to buy the company's shares or stocks or equity. Shares, stocks, equity, they're kind of interchangeable terms in finance, accounting, in the more generally speaking. And the second way to invest in a private company is to give the company loans. If you buy the company's equity, then you're doing private equity investing, and investors who own equity in a company are called shareholders. If you gave the company loans, you're doing private credit for the company, and then investors who lend money to a company are called creditors. And if you invest in a private company, you're called private creditors. So what is the difference between these two approaches? Why would people choose one over the other? Sorry, let me make sure you can see this part too. So I made this comparison table and I'll walk through not all of it. Just kidding, I'll walk through all of it. But the most important thing to focus are those ones that I highlighted here. When you're a shareholder, you are actually the owners of the company, especially when you buy common equity, common stock. When you're a creditor, you're just lending money to the company, then you're a lender, you're not owner of the company. You have no, actual control of the company. You have no stake in the company. And the financial claim that you have by being a shareholder is you have equity. And by being a creditor is that you have the debt owned by the company to you. And the risk is one of the key differentiator when people consider whether they want to become a shareholder of a company or a creditor to the company, or sometimes in some less common cases, or both. With shareholder comes higher risk, right? Because you are the owner of the company, you're basically ride and die with the company. And the returns when you own shares is really depending on company performance. If the company perform well, that's great. You are basically soaring to the sky with the company. But if the company is performing really poorly, you're going down to the pit of despair with this company. With creditor, it's a much more contained risk. You earn fixed returns through your interest payment. When the company has tremendous performance upside, you have nothing to do with that because you choose a more risk averse and also return averse approach by being a creditor. If the company makes zero money, the good thing about being a creditor is if the company makes zero money or the company is going downhill, you're still getting payment from the company because you're a creditor. You have lower risk because it's almost guaranteed that you have an interest payment. And the way you receive returns are different because for shareholders, you own stocks. And if you have traded stocks on the open exchange market, you can buy low and sell high. And that stock appreciation is your capital gains. And some stocks pay dividends. They're like, okay, we're going to pay $1 per every share for all the stock you own. So a lot of the very established corporation, they pay dividends, like Coca-Cola pay dividends. I cannot think of other things on top of my head, but generally younger company use their extra money to invest in their R&D, but more established corporation use their extra money to pay dividends to the shareholders. But again, dividends is not guaranteed. But for creditor, your return is just the interest payment based on the term that you agreed with the company when you loan your money to them. So you are always getting, let's say, 5% back on every $100 you loan to them, and so forth. The good thing about being a shareholder is that you typically have voting rights, especially when you purchase common stock. The great thing about common stock is it comes with voting rights. What it means is that you can vote and decide and control and influence the company's operation, the management personnel they bring on, and a lot of manufacturers like vendors, and so forth. With creditors, you have no voting rights. It can be a good thing, can be a bad thing, really depends on how comfortable you are with. Do you not want to invest too much time to study all the things you need to vote on? Or do you actually, I don't know, maybe some people prefer, they want voting rights, but they don't want too much risk associated with being a shareholder and having voting rights. So it could be good and bad. And priorities in terms of liquidation. In business world, when we say liquidation, it could mean the owners selling the company, so sale. It could also mean the company is going bankrupt, is liquidating, or the owner decide to get out of this business. They want to just dissolve their company and move on to something else. So dissolution is another form of liquidation. So in other scenario where basically the company will no longer exist, how do the whatever is left in terms of like cash or other assets get distributed to people who have sort of relations with this company? So in the event of liquidation, creditors always have higher priority than shareholders. Meaning, let's say the company went bankrupted and they only have $100 in their bank account. How do we distribute the $100 that's left in their bank account? Well, creditors get paid first and shareholders get paid second. What if in the case that, this $100 only has enough, is only enough to cover the creditors but not enough shareholder, and then too bad, shareholder gets nothing, all right? Because you assume the risk, you're ride or die with the company goes down, you go down with it. When there's no money, then you get no money. And the duration of investment is different as well. It really depends on, do you have a long-term perspective in this company? Do you want a short-term perspective? Or do you just want prefer shorter term of investment period? because with credit, it really depends on the loan terms and bond maturity. But as we all know, no loan or no bond is like forever, right? Like I'm not gonna pay you back. I'm not gonna. You never get a mortgage or anything that's like, oh, the term is forever. You just keep paying till, I don't know, like forever and ever. But with stock, you can hold it indefinitely. You can pass down to your children, your grandchildren, your next generation, like however long you want. But that's not the same thing you can do for debt, for credit. It always comes with a term, usually measured in years. Okay, so now we just talk about the difference between shareholders and creditors. And their instrument is the shares and the bonds, right? The debt. But then as time evolved, and again, finance, accounting, these are human-made science, or some people call it art. So people are thinking, wait, hold on a second. If I invest in common stock, I become a shareholder, there's a lot of risk, right? If the company goes down. But there's also a lot of upside if the company performs well, because I can, participate in the profits. But then I don't like the risk of common stock. I like the security of bonds, but bonds are very limiting. Is there something in between that can make other people, like, is there something in between that's hybrid that can get kind of the best of both worlds within a limit? So people invented preferred stock, which I added a column here in the middle. Both of these are called stocks. Both of these are shares. But with preferred stock, what's really interesting is a hybrid of between equity and debt, or equity and debt. It has characteristics from both categories. And the major difference is it does not represent ownership. If you are an investor and you only own preferred stock in this company, it doesn't represent your ownership in the family, in the company. You have no stake, and you have no voting rights. They pay a fixed dividend, higher priority. So if anything bad were to happen, the company goes bankrupted, creditors get paid first. Remember, we just talked about liquidation right here. Creditor gets paid first when they hold bonds, and if there's any money left, it goes to preferred stockholders. And then, if anything left, there's common stock holders. In terms of risk level, as you can imagine, because this is a hybrid that people want to create to fit in between common stock and bonds, preferred stock sits in the middle between common stock and bonds. And return potential, same thing, sits between, because you're kind of assuming the in-between level of risk. In terms of liquidation, same thing, highest is always creditor, and then if there's anything left, it goes to preferred stockholder first, and if there's anything left, there's the money goes to common stockholder. If there's nothing left after they pay the creditors, too bad, none of the stockholder receive any money. Maturity, similar what we just discussed above. Okay, now you'll be asking, I just talked about shareholders and creditors, then I just talked about common stock, preferred stock, and bonds. Why do I need to talk about all of this? Great question, we're getting close. I want to talk about this capital structure, simple capital structure versus complex capital structure. Okay, what is simple capital structure? Always start with the simple one. Simple capital structure means this capital structure consists only of common stock. It usually looks like, if you go to their balance sheet, where they document their assets, liability, their stockholders' equity, you will only see common stock as the only share class. In this example, they have 1 million shares outstanding common stock. And because there's only common stock, there's no liquidation preference, there's no seniority, there's no participation, there's no conversion. None of this is applicable when you only have common stock. So why do I still list these 4 columns, even though they are NA here? That's because I want to make a contrast with what I'm going to talk about next, which is complex capital structure. So just hold on tight. Let's move on to complex capital structure. Okay? Complex capital structure, in contrast with simple capital structure, consists of multiple classes of equity with different contractual rights and preferences. So again, here's an example I made up. And as you can see, the liquidation preference, seniority, participation, and conversion all being populated. So let's break it down a little bit more to see what it means. So usually company will start with common stock. When you form a company, when you bring on your business partner, your first couple of investors, you only issue common stock, and this is all you have. And then you realize, okay, we're running low on cash. We need to go and raise more money from other investors, new investors typically. So you go out and you start issuing Series A, Series B, Series C. You probably have seen this on the news if you follow startup development. They will say, oh, so this startup so-and-so raised a new Series C round of money, and that put them over $1 billion valuation. They become the unicorn. When we say unicorn, that means their valuation is about $1 billion US dollars. So as you started issuing preferred stock, you name them based on the round of when they are issued. So if it prefers Series A, that means they're issued in Series A fundraising, and Series B fundraising, and so forth. And then I made up some number for shares outstanding, and then I have this liquidation preference. What liquidation preference means is that this is the money that usually people paid for when it's all in their preferred stock agreement. When the investor come in and purchase these preferred stocks, this is the money they are guaranteed to get paid when the company liquidates. Get paid per share. So $4 per share for 5 million shares for the investor who owns Series A in the event that a company liquidates. And again, liquidate just means they sell the company, they go bankrupted, or the owner just doesn't want to own this company anymore. They're getting out of this business, just like, we're gonna dissolve our business and move on. And then we have this column called seniority. For simplicity reason, I just put 1, 1, 1, 1, and 2. That means these three preferred stock classes, they all have the same seniority, meaning who gets paid first. There will also be scenario where they can have 1, 2, 3, 4, meaning in the event of anything bad to happen, Series C gets paid first, Series B gets paid second, Series A gets paid third, and then common stocks gets paid last. But these are all negotiable, and it really depends on the preferred stock agreement between the investors and the company of investment. And participation, this is another concept I will hopefully talk about later in the future. Conversion is more easily explainable. So if you remember what I just talked about, when you have preferred stock, you actually have no voting rights. When you have preferred stock, you're not a shareholder. When you have preferred stock, you only get paid dividends. You cannot benefit from the capital gains. Capital gains just when stock appreciates, when the company does really well. But people are smart, right? Investors are smart. And again, business is all this concept I'm discussing now is human-made logical science. People basically said in the past, like, hey, I know we just invented preferred stock to, kind of get the benefits of both worlds from equity and bonds. But, can we add a little bit more flexibility to say, hey, in the future, when the company starts to do really well, we want to become a shareholder and own common stock and no longer own preferred stock, so we can participate in all the profits that the company is making. And this is where people invented conversion. That gives the preferred stockholders an option to convert their preferred stock into common stock if certain conditions are met. Really clever, right? Really, really clever. Oh, there's actually a story I want to tell about the difference between common stock, preferred stock, and bonds. And it's a super relevant story at this time of recording. if you have not heard about the drama that happened within OpenAI in, I'd say, November 2023, I linked this article here. I also link down below in the video for you to look at. Basically, the gist of it is OpenAI is the creator of ChatGPT, DALL-E, and they're one of the most popular startups right now in the Silicon Valley. And what happened last year was that one of the founders, Elia, went to the board and had board fire Sam Altman, and then after they kind of like blindsided Sam Altman, the president of OpenAI, Greg Brookman, quit the job, and this all happened within 2 days over a weekend. And then Microsoft, who is one of the biggest investors in OpenAI, they came in and wanted to rescue Sam Altman, but then somehow Sam did some maneuvering, and then he was reinstated as the CEO of the company. Anyway, lots of details, lots of drama. But what's really interesting is that Microsoft had no idea the firing of Sam Altman was coming when that happened, and that's because Microsoft did not have a stake in OpenAI. They invested $13 billion, more than $13 billion to date at the time of recording, and yet they have no voting right on the board. They have no control authority whatsoever. And they said, while details of our agreement remain confidential, it's important to know that Microsoft does not own any portion of OpenAI. So what happened over a weekend was a completely blindsided event for Microsoft. They scrambled to come up with a plan to rescue Sam, and so. And it was not until everything blew over, aka when Sam took control of OpenAI again, much later at the end of November 2023, Microsoft gained a board observer, again, non-voting observer seat on the board of director after they elected a new board of director for OpenAI. So pretty interesting, right? $13 billion and still no voting rights, no ownership. And it has its good and bad, but I just figured that's something that's really relevant and interesting to share, because you probably have seen it on the news.